Hi guys, welcome to my channel, and thank you so much to those who are returning subscribers, and to those who haven't subscribed, please do like and subscribe. And if you haven't watched the previous videos, please do yourself a favor, start by watching those previous videos to make a catch up, and start by watching from 1 to 13 because it's a compilation of all of them. So it's a compilation from the beginning up to where we are now, and it will be much beneficial if you go that route. Okay, so today the learning unit 14, we want to talk about materiality and audit risk. And per usual, I'm not going to be posting the study guide or parts of the study guide here for copyright purposes. If you need that study guide, you should download it at Telegram groups, or any other official Unisa platforms. If you by chance listening to this recording and it's not in 2021, or it's not a cause for concern, remember auditing is not really so dynamic. It doesn't really change much. So what auditing was 10 years ago, it's still the same, meaning the same material that I'm going to be giving you now, they're still going to be applicable in your studies, and you just have to use the information that you have. If you can get this study guide, which I'm using, which is AUE 1501 2021, the better, or we can just use the one that you have. So today we're going to be talking about materiality and audit risk. So when you're talking about materiality, the only thing that you just have to recall there is, like, for something to be deemed material, the same way in the English definition or the English understanding of it, it's like it's important, right? It's important, or it's something that is not worth ignoring. That's what they talk about materiality. So before you consider something, so remember, you'll be going through documents, you're going to be going through source documents, and you're going to be going through procedural, you're going to be going through probably incident reports and a whole lot of things. There are some things that you can say these are important. There are some things that you can say, okay, these things maybe I cannot, yeah, they might be important, but I can probably not really take them into consideration much. So using professional judgment, you as the auditor, when you're collecting evidence, you now have to define or to decide, okay, what is it that I'm going to deem important to the financials, to the audit report. So for instance, if there's going to be certain things that are omitted, right, some omissions are going to be material, right? Some omissions are not going to be material. Let's say, for instance, the company secretary omitted to record notes of a certain meeting, and the meeting, probably they were talking about something that is not even related to that doesn't have really much of a monetary value. Maybe it's just a community responsibility item. So certain omissions, they are not really material, certain might be. So the definition of audit materiality, also for something to be material in definitions of auditing, it must have like the following things. It must be an important omission, number one, or a misstatement. A misstatement is basically stating something amiss, right? You are supposed to put something as 1,000, you put it as 100. So which means you have misstated that item, probably to be sales. Your sales was 1 million, but for one reason or the other, you put them as 100,000, or you put them as 10 million. So which means you have misstated something. Or and that misstatement or that omission has implications to the users. So meaning, if you're going to misstate sales probably by 9 million, meaning it was supposed to be 1 million and you put it as 10, definitely your profit figure is going to be affected, right? So because your profit figure is going to be affected, profit also goes on and affects your owner's equity in your capital. And now the business now looks like it's doing good where it might not really have been doing good, meaning that misstatement has implications. So before you can just deem something as material, right? Before you can deem something as material, it has on its own or in aggregate must have the ability to influence a person's decision making. So a person must be influenced by that omission. That's what they mean. They are saying it is considered material if individually or in aggregate, meaning if all those mistakes or omissions are expected to influence the decision of someone. So imagine you are having sales, and remember, income minus expenses will give you profit. And you go ahead and you omit certain expenses from your calculation of profit. It automatically means your profit figure is going to be wrong. And because it's wrong, it might also now affect people in otherwise. In news, there were cases around staying off and all those things where certain things were stated which were not the actual version of things. And people ended up investing in a company which was not really doing so well. But financially, according to accounting records, it looked as if it was doing well. So you have to be wary of that. So another thing that we have to quickly look at, we have to look at audit risk, right? So audit risk, remember, audit risk is now a risk. Remember, risk simply means susceptibility to danger, right? Susceptibility to danger. That's the simple definition of risk. So when you're dealing with audit risk is now that the thing is now a risk on the auditor, because we now are having a risk where the auditor might say or express an opinion which is incorrect, right? Audit risk simply means the auditor might express a risk, might express an opinion which is incorrect. A lot of things cause the auditor to cause an incorrect opinion, but one of the things that they highlight there for you is the financial statements being materially misstated. So they speak about two things there that I just want to briefly explain to you. So the two things that they're talking about there is now they're putting two words together, right? And these two words, you're going to be coming across them a lot. So they're now putting two words which they're calling materially misstated. So materially misstated means materiality. Remember, we said it's important, right? So there was an important thing. Why do we call it important? Because it has an impact on making a decision. So something that was very important was not stated correctly. That's what they mean by material misstatement, right? So the auditor is now going to express an incorrect opinion. Why is the auditor expressing an incorrect opinion? They're expressing an incorrect opinion because something that was stated, it was stated incorrectly. Something in the financials, which is very important or a key component, was incorrectly stated in the AFS, annual financial statements. For instance, if you go and incorrectly state your assets, your AFS is supposed to balance. It might balance on the incorrect figures because you have gone and misstated things, and because you have misstated things, there is now an audit risk, or the risk that the auditor is going to express an inappropriate or an incorrect opinion. For instance, the auditor might now say everything is okay or everything is fairly present when it's not. Or the auditor might say there is one or two issues where there were not even one or two issues, but it's being caused by the misstatement. So risk of material misstatement, right? So we have to now go and look at the components of audit risk, right? So if someone is saying there's an inherent risk, IR simply means that it's inbuilt. It's an inbuilt risk. That's what they mean there by inherent risk. It's an inbuilt within the auditing, within the accounting software or within the processes of accounting. There's already a risk that is already underlying already, that things might be incorrect. So that's what they call inherent risk. Control risk, right? Control risk, they go on to define control risk as the risk that the misstatement could occur in the account balance that could be material and could not have been prevented or detected by the entity's internal control. So control risk relies on the internal control. Remember, we spoke about internal controls, I think previously, where we said internal controls, these are measures which are put in place by the organization to limit risk, right? So the control risk is the risk that those controls that you have come up with, they are not sufficient. They are not sufficient. Inherent risk, these are risks that are already underlying. They have nothing to do with your internal control. right? There is nothing, even though your internal control is okay, there's still a risk that something could go wrong. That's your inherent risk. Then the detection risk simply states that it's the ability of the auditor to detect the risk. So the detection risk is on the auditor. So here they explain it to us by saying detection risk is the risk that the procedures performed by the auditor might be inefficient, or they might be inadequate, right? The I beg your pardon for that. Let me just take a retake on that one. Detection risk, right, is just saying the measures that the auditors might have, or the tests that the auditors might have, might not be sufficient to identify the risks that might be underlying. So they come up with an equation there saying IR plus CR plus DR is equals to AR. So that equation that you have there, AR is standing for audit risk. So your audit risk is going to be your inherent risks, which are risks that are not related to internal control. Control risks, which are risks related to internal control, plus your detection risk, right, to get to your audit risk. So you have to understand internal control and its role, right? Internal control, these are measures put in place to minimize risk. So if these measures are not 100%, if these measures are not 100%, they create for you a control risk. But beyond your internal controls, there's still a risk that things can go wrong. That is your IR. Then what you can control, or the measures or the tests that you're going to be doing as the auditor, if they are not going to be sufficient, it creates a detection risk. All those things added together will create for you an audit risk, and an audit risk being the risk that you are not going to give a correct opinion. So this is what they're talking about in this chapter 14. So please make sure that you do give comments, or if there's any part that you didn't understand clearly, do give comments and I would definitely revert back to you. Also try to watch the videos that they have there as links in case it enhances your understanding of the module. Remember to like, subscribe, and thank you so much for your time.